Welcome to the Deep Dive. I'm your host.
And I'm the resident researcher for today's session.
Great to have you here. So today we're digging into a stack of research notes centered on this really fascinating academic framework. It's called GOA-61.
Right.
And it basically models the macroeconomics of risk.
Yeah, it's a very specific lens on risk.
Yeah. And our mission today is to figure out how the uncertainties of the future, like all the things we don't know yet, are actually acting as this hidden tax on the present.
Exactly.
Because, when you think about building something big like a massive bridge, you usually worry about the physics.
Right, like the engineering side.
Yeah. Can it hold the weight?
Yeah.
Will the steel hold up to the wind?
Yeah.
That kind of thing. But the framework we're looking at today suggests that the bridge might actually collapse before a single ounce of concrete is even poured.
Which sounds crazy, but yeah.
Not physically, obviously, but practically. Yeah. Because the cost of underwriting the future risk of that bridge just became astronomically high.
Yeah, and we're looking at a fundamental shift here in how the future interacts with today's economy. Because this isn't simply a story about higher interest rates or rising insurance premiums.
Right. We hear about those constantly.
We do, but this is about whether those prices are actively carrying future uncertainty into our present-day decisions. And by doing that, they're actually changing which futures remain reachable, for different actors.
Right. And that brings up the core unresolved question of this entire GOA-61 framework, I think. We really need to figure out if a situation where risk is, extremely expensive but still underwritten is structurally different from a situation where underwriting itself just completely stops working.
Yes, that is the critical boundary.
Because paying a lot for insurance, it hurts, right? It hurts the bottom line.
Oh, absolutely.
But not being able to buy insurance at any price, that literally stops the world.
It halts everything.
Yeah. So we need to update our mental models right off the bat here.
Yeah.
And I think we need to draw a hard line between two concepts, prediction on one hand and underwriting on the other.
Right. So let's break that down. We've spent, decades obsessing over prediction.
Yeah, big data. Right.
Exactly. Gathering massive data sets, running these insanely complex models, and essentially just guessing what will happen.
Trying to read the tea leaves.
Right. Figuring out, okay, there's an 80% chance of a supply chain disruption this year, or predicting a specific frequency of severe weather events in a certain region.
Like having the perfect crystal ball.
Yeah, but underwriting is an entirely different mechanism.
Okay, how so?
Underwriting asks a completely different question. It asks, who can actually carry the cost, the loss, or the uncertainty if that event actually occurs? And crucially, under what conditions are they willing to carry it?
It's like, it's the difference between a meteorologist and a roofing contractor.
Oh, I like that. Yeah.
Right. Because the meteorologists, they can perfectly predict that a massive hailstorm is coming, right? They can tell you the exact hour it will hit your neighborhood.
Down to the minute.
Exactly. But that perfect prediction, it doesn't put a roof over your head.
No, it doesn't do anything to protect you physically or financially.
Right. The underwriter, and so in this case, the roofing contractor, or I guess the insurance company backing them, they are the ones who actually agree to carry the financial burden of replacing that roof when it inevitably gets smashed.
Yes.
And if nobody is willing to take on the financial risk of being the roofer, well, the perfect weather forecast is completely useless to you.
That roofing analogy it's perfect because it exposes the real shift in the axis of competition right now.
What do you mean?
Well, we aren't really competing on reading the weather anymore. We are competing on sustaining the uncertainty of that weather.
Oh, wow. Okay.
Right. So even if we possess perfect predictive accuracy about the future, if the capital or the insurance or just the buffer capacity isn't there to absorb the shock, we literally cannot step into that future.
You're just stuck.
Yeah. Our focus has to move from predicting the future to figuring out how future uncertainty becomes a present-day condition, and how that creates differentiated reachability between different players.
Differentiated reachability.
Right. And ultimately, where the actual boundary lies between a high price and just a total failure of underwriting.
Okay, so let's follow that logic. Because if underwriting is the actual gatekeeper to the future, and the gatekeeping costs are skyrocketing because the future just looks inherently more uncertain, the GOA-61 framework introduces this concept of, what do they call it, future option compression.
Yes. Future option compression.
And the research lays out this really specific chain reaction, starting with future uncertainty. But wait, let's slow down here for a second. Because how exactly does an abstract future uncertainty translate into a present-day decision? Like, Give me the actual mechanics of how a risk that might happen, say, 20 years from now, changes a CEO's mind this morning.
Right. It can feel a bit theoretical, but the translation mechanism is actually very concrete. It's pricing and underwriting conditions.
Okay.
So let's say climate models predict significantly increased coastal flooding over the next 30 years. That is the future uncertainty.
The meteorologist telling us the storm is coming.
Exactly. Now, insurance companies and banks, they take that prediction and they immediately adjust their risk models today.
Right.
They raise premiums or they demand much higher capital reserves for a loan on, say, a coastal warehouse.
Oh, I see.
So those new underwriting conditions instantly become present decision conditions for the CEO.
Got it.
The CEO wakes up, looks at the new cost of capital and the new insurance premiums, and suddenly building that warehouse is just no longer economically viable today, even though the flood hasn't happened yet.
It might not happen for 20 years.
Exactly. But the option is compressed today.
Wow. So the future uncertainty just compressed their options in the present. It reached back in time and killed the project.
Effectively, yes.
But we have to be careful here, right? Because we don't want to paint this as some apocalyptic sci-fi scenario where the future is just vanishing for everybody.
No, definitely not. And the text is very specific about this.
Right.
It clearly distinguishes between different actors losing access to a pathway versus the pathway becoming completely unsustainable across the entire market.
Okay, that's a really important distinction.
Yeah. The earlier stage of this compression is simply differentiation in future reachability.
Which means what exactly?
It means the door to the future is still technically open, but the toll you have to pay to walk through it has become heavily stratified. It's based entirely on who has the balance sheet to actually absorb the risk.
Okay, so if we have like a regional logistics firm trying to build that coastal warehouse we talked about,
Yeah.
the new insurance premiums might just wipe out their profit margin completely. So they have to retreat. They have to delay the project or maybe scale down and build it inland instead. They're effectively priced out of that specific coastal future.
Exactly. But a massive multinational corporation
Oh, right.
with, huge cash reserves, they can just self-insure, or they can easily absorb the higher interest rates or build redundancies like their own seawalls.
Yeah, to them, it's just a rounding error.
Exactly. So they maintain the reachability. The pathway remains available, but only for those who can carry that heavier burden of uncertainty.
That is fascinating. So the choice is compressed for the smaller, less capitalized players first.
Always.
But the framework pushes us to look past that initial stage, right? Because we have to examine the exact boundary where an expensive option crosses over into being a completely unsustainable option for everyone.
Right, the breaking point.
Yeah. So smaller players get squeezed out first. But what is the actual breaking point? Is there a mathematical boundary where an expensive toll just becomes a totally closed bridge?
Well, the research sets up two specific scenarios to explain this. Scenario A is exactly what we just described. Risk gets very expensive, but someone with deep pockets is still willing to carry it.
So the project still gets built.
Exactly. It's just a high-cost, functioning reality. It's expensive, but it works.
But scenario B is where it gets really complicated, doesn't it?
Yeah. Scenario B occurs when the underwriting conditions fail entirely.
Which means no one is willing to carry the risk.
Right, and this happens for a few reasons. Maybe the risk cannot be assessed because there's just no historical data to model it.
Like totally unprecedented weather events.
Exactly. Or maybe regulation just outright prevents the underwriting.
Right, sure.
Or the required price is just so economically absurd that literally no one, not even the multinational corporations, can pay it and still operate a functional business.
Wow.
So when underwriting fails, the pathway may become incredibly difficult to sustain under existing conditions.
The bridge is closed. So, okay, if I'm a mid-size infrastructure builder and I hit scenario B, let's say I literally cannot get an insurance policy for a new port development. I assume there's a pretty nasty domino effect.
And a huge one. And the sources actually lay out a specific sequence for this. It starts with insurability, then it moves to financing, then contractability, and finally operational viability.
Okay, let's walk through that. Because without a policy, so insurability fails.
Right.
Then the bank looks at my uninsured port as toxic collateral.
Basically, exactly. They won't lend against an uninsured asset, So they pull your financing.
Financing fails.
And without financing, you have no capital backing to guarantee your end of any long-term agreements.
Ah.
So your vendors, your construction partners, your suppliers, they aren't going to sign contracts with you.
Because I can't prove I can pay them.
Exactly. So you lose contractability.
Contractability fails.
And without those contracts in place, the entire operational viability of the project collapses. The pathway just completely halts.
Man, it just all falls apart. But we should probably caveat here, right? Because insurance doesn't control literally every single economic activity on the planet.
No, of course not.
Like some localized stuff or purely digital activity software startups, they might bypass it to some degree.
Sure.
But for massive, physical, future-facing projects like power grids, ports, massive housing developments, it really acts as the absolute bedrock, doesn't it?
It absolutely does. If the underwriter walks away, the whole stack falls apart. The physical world completely relies on that stack.
Yeah.
And to ground this even further, we can look at how long-term interest rates function within this framework.
Oh, this is a great example.
Because the traditional view usually labels interest rates as simply, the price of money or the price of the future.
Well, standard economics class stuff.
Right. But GOA-61 frames them very differently.
The text calls long-term rates a friction surface, which I thought was a really evocative phrase.
It is.
Because friction implies heat, right? It implies resistance, something dragging.
It's an interpretive structural framing. Think about the mechanics of a long-term project. When a government commits to building, say, a 20-year high-speed rail network,
Yeah.
they are essentially trying to pull future cash flows and future economic value into the present moment because they need to fund the concrete and the steel they have to buy today.
They need the money now to build the thing that will make money later.
Exactly. So long-term rates are the friction they encounter, dragging that value forward across time.
Dragging it across time. Okay. So if you're listening to this and you've tried to get a 30-year fixed mortgage recently, you've definitely felt this friction surface firsthand.
No, absolutely.
Because you aren't just paying for the lumber and the land of the house. You're actually paying the cost of the bank's uncertainty about inflation, job markets, and global stability, stretching all the way out to, what, 2055?
Exactly. When the world feels stable, that friction surface is smooth.
Yeah.
The rates are low, and it's easy to drag the future into the present.
But when future uncertainty rises,
that friction surface gets incredibly rough. It heats up. It requires significantly more energy and more capital to pull the future into the present.
wow.
The bank is essentially demanding a larger premium to underwrite the uncertainty of the next 3 decades. And if that friction gets too high, the borrower just can't drag it anymore.
They just let go.
Yeah. The household abandons the mortgage application. The government abandons the rail project.
That friction surface concept, it makes perfect sense for financial instruments like mortgages.
Hey.
But where this gets deeply tangible and honestly kind of scary is when we apply it to technology,
Specifically AI.
specifically AI infrastructure. Because we tend to view AI as this magical, infinite digital frontier. It lives in the cloud. It feels completely weightless, just code and math, endlessly scaling into the future.
Right. But it is utterly tethered to physical constraints.
It is so physical.
AI serves as a perfect representative example of the limits of technical capability, because we could have a scenario where GPU power doubles every single year, and algorithmic efficiency skyrockets. But the AI industry still faces the rigid boundary of physical underwriting feasibility.
Because an AI data center isn't actually a fluffy cloud.
No, it's not.
It's a massive concrete warehouse filled with thousands of roaring servers that require an insane amount of energy, and they get incredibly hot.
Exactly.
So the relevant conditions for that AI future are intensely physical. We're talking silicon chips, gigawatts of electricity, massive water draws for cooling.
Huge amounts of water.
Right. Plus land acquisition, high voltage transmission lines, and the long-term capital to build it all.
So let's apply the GOA-61 framework to that.
Okay.
The technologist predicts that AI will revolutionize the global economy.
And the prediction is clear and incredibly optimistic.
But the underwriter asks a completely different set of questions. They ask who is going to guarantee the water rights for those massive cooling systems for the next 20 years.
Oh, man.
Right, because if a local municipality looks at climate models and drought forecasts, they might just refuse to sign a 20-year water guarantee for that data center.
Because they literally can't underwrite the water risk for their own citizens, let alone a server farm.
Exactly. Or, If a utility company can't secure insurance against the risk of the local power grid collapsing under this massive new load, then the transmission lines just don't get built.
That's period.
Right. So when those physical inputs can't be underwritten, the technically possible AI future becomes practically unreachable.
The data center doesn't get built.
The technological promise hits the friction surface of physical underwriting, and the pathway becomes difficult to sustain under existing conditions.
Right. So the tech exists, the code totally works, but the future stalls because we can't price the water risk.
Exactly.
That exposes a massive mechanical problem between how these different systems operate, doesn't it?
Right.
And the text calls this a velocity mismatch,
Yes, velocity mismatch.
which is essentially just the friction between digital market speed and physical construction
Yeah.
speed. Right.
That's the core of the mismatch. Prices, risk models, and contractual conditions, they can move with incredible speed.
lightning fast.
But physical infrastructure just cannot. Think about the tools of the financial layer. A bond market can reprice the risk of an entire global sector in a matter of hours.
Right.
A major insurance company can update its policy terms, change its deductibles, or literally pull out of an entire region in a few weeks.
Yeah, just based on a new risk model updating on a Bloomberg terminal somewhere.
Exactly. The numbers on the screen change instantly.
But the physical systems that rely on those numbers, the power grids, the shipping ports, the global logistics networks, the housing developments, they take years, sometimes decades, to adjust.
It's a completely different timeline.
Even things like household incomes take years to fundamentally shift to adapt to these new prices.
And this velocity mismatch, it essentially traps operators in the physical world.
How so?
Well, the financial layer is reacting to future uncertainty today. They are immediately raising the price of access or changing the underwriting conditions right now. But the builders, the city planners, the infrastructure developers, they are constrained by the physical speed of pouring concrete, forging steel, and, navigating multi-year regulatory approvals.
Ah, I see. So they're essentially being asked to pay tomorrow's hyper-adjusted risk premiums using yesterday's physical infrastructure.
Yes.
The speed of the price change vastly outpaces their physical capacity to adapt.
And because they can't adapt their physical reality fast enough to meet the new financial conditions, they hit that boundary we discussed earlier.
Scenario B.
Exactly. The underwriting fails, not because the project is inherently flawed or the technology is bad, but because the temporal friction between fast prices and slow reality completely breaks the financial model.
Wow. Okay, so we really have to circle back to the observational question that drove this entire analysis from the start.
Right.
Under what conditions does reachability narrow, and where does maintaining a pathway become difficult?
Right.
Because the framework makes it so clear that the world isn't paying for what the future actually is. It is paying the price required just to stay connected to it.
Yeah, that's beautifully put. The cost of that connection has become the new critical metric.
Yeah.
It's no longer just about the cost of the technology or the cost of the labor. It is entirely about the cost of the certainty required to proceed.
And when that certainty cannot be priced, the pathways narrow.
They narrow, and eventually they become unsustainable.
Which leaves us with a pretty heavy realization about how we are building the next few decades, I think. Because if our current financial and underwriting systems are acting as the ultimate gatekeepers of which futures are actually reachable, what happens when a highly beneficial future for society falls into the category of failed underwriting?
Like a scenario where we desperately need a specific pathway, but the current mechanisms just cannot price the risk.
Exactly. What if a massive clean energy transition, or, I don't know, a revolutionary update to our medical infrastructure simply fails underwriting? Because its long-term physical risks like grid constraints or unpredictable weather patterns stretching over decades just can't be neatly modeled by today's fast-moving price metrics.
This is a huge question.
If the toll on the bridge is too hard to calculate for the underwriter, do we really just choose never to cross the river? Do we just leave that future behind? It's a structural bottleneck that goes way beyond standard economics, and it's definitely something we all need to be thinking about. Until next time, thanks for taking this deep dive with us.